This is the Financial Coconut Podcast, Singapore's first personal finance podcast network. My name is Rakesh, and together with Anthony, we discover worthy financial news and derive insights for all you coconuts. We are part time investors with an intense full time career. If we can do it, you can too. So join us every Thursday for TFC Weekly Market Updates. Hey coconuts, welcome to another weekly market updates with me, Rakesh, where we scour the net to find worthy financial news for you. This week, one of the biggest ones so far is the debt ceiling. We've all heard some news about it, the back and forth. So, is it finally going to pass? We're going to break that down. But also, what does that impact? Does that impact the US equities? Does that impact the credit rating agencies? What does that mean for the interest rates and the yields? And does that mean that the US market is still attractive? So, those questions are being broken down in our conversation today. And just like it, is there another place that we could put our money into? So we talk about the effect of the US debt ceiling on the Nikkei stock market. Japan has been low over the last 20 over years, but is now the time that the snowball is starting to grow again. We break that down for you with Kelvin Ong, the senior market analyst at Oanda. Let's get to it. Hey coconuts, welcome back to another weekly market updates with me, Rakesh.
And Anthony, and our guest today, Kelvin.
Thanks for inviting me
How
again
are
to the
you?
show, Anthony and Rakesh. Yeah, good, not too bad. Finally, it's getting a bit hotter in Singapore for whatever reasons. Yeah, and the US market is getting hotter as well. Yeah.
I mean, we have to thank Indonesia for the clear skies soon.
Okay.
So,
Yes,
we will
we have to
see.
pray about that one.
Wow.
3 stories for you, coconuts. First,
Alright.
we're going to start off with debt ceiling. US debt ceiling, obviously, there's been a lot of news in that, a lot of uncertainty, so on and so forth. So we've got Kelvin here today, and who better to talk about that? And of course, the Nikkei stock index. So how is the effect of the debt ceiling really going to relate to the Japanese market? I think that's it's all about Kelvin today, lah. So it's always nice.
Well, I try my best. Yeah. So now start with this debt ceiling, or we call it debt squabbles, between the Biden's administration and as well as the House. The story goes over here is this: Democrats right now are more progressive, or the liberals. Okay, so what they want to do is that they're talking about social costs. So social spending help to close the gap between the very rich and the very poor. So you need spending, right? Then on the Republicans, we have the conservatives. And these conservatives can be the very, very ultra conservatives like Donald Trump and his camp. Right now over here is that the key thing is on the broad is that the current House is being kind of controlled or ruled by the Republicans. Okay, by midterm election. Previously was Democrat. All right. So previously administration Democrat Biden, House Democrat, Senate Democrat. So now is House Republican, Senate Democrat. So now the problem over here is the House itself is owned by the Republicans, and this Republican House Speaker that is the one that is the point man to actually negotiating this current debt ceiling deal with the administration, which is the Democrats and Biden. He doesn't has the political sway of the conservatives Republicans. That means the conservative Republicans actually doesn't have the 100% full support of the current House Speaker, which is McCarthy. So right now, in the last couple of days, there's some positive sign. Okay, McCarthy, together with the Democrats negotiator, they actually come up with a tentative deal to actually, number one, hey, you guys can do social spending, but you can't do so much. So ding dong here, ding dong there in a nutshell, they agree to actually increase the debt ceiling, the extension of that ceiling about, now it's about 21 trillion something plus, extend it, and also more importantly, suspend the debt ceiling for 2 years. So that is 2 years grace period. That means if this is finally...
and I think crucially also after the next elections. Right?
Just like
both of them
2024.
want to push. Yes.
Yeah, so both of them is not effort. Okay, they can say that, hey, we are trying our best to make sure that US technically
of course they will blame the other.
Trying our best.
Trying our best.
They will say, oh yeah, I try my best, but the other side, so unreasonable. Both of them, they are always right. The other side is always wrong, right?
Correct.
But
precisely.
and I think right now where we are is that this will go to a vote soon, so we'll know whether there is an actual resolution to the debt ceiling debate this week.
The debt ceiling on Sunday itself, everything is kind of the definitive deal is being finalized. So there's a rule in the House rule say that the House lawmakers, they have 72 hours to actually read these details before they put into a vote. So that will come on Wednesday. So right now, in fact, starting from yesterday, they actually start a lot of video conferencing between their own camps within camps. Okay, because they got a lot of sub-faction in US. Even though I'm a Democrat, within Democrat there are various factions. Okay, so now there's a lot of lobbying going on within the camps to actually hopefully
Get it approved.
to get it approved, to get everyone consensus right. So by Wednesday, once it's approved, and now the X date itself, Yellen, the US Secretary said is 5th of June instead of 1st of June. So as long as I think
She found a few more days.
Yeah, she found.
They're like, suddenly I got a few more days.
Yeah, she got a few. I don't know whether she got. Suddenly, it seems to me that US itself, they managed to dig up some coffers, some money from some IR to actually, okay, for 1st of June, push it 5th of June. So now the big question is, there's a lot of optimism going on in the markets, right? So you could see last Friday, right, especially post Nvidia stocks, post Nvidia earnings, and the Nasdaq 100 actually rallied further. So year to date is still the strongest outperforming stock US majors benchmark stock index, outperforming the Dow Jones and the Russell 2000. So they are up year to date by close to 30%. So now the big question here is, okay, even though we're talking about on Wednesday, the best case scenario, everything is passed. So the next step is the US government got to replenish their coffers. So right now, their cash balance, the treasury cash balance is very, very low. So they are running close to at 2017 levels, as 2017 September level low. So right now, based on certain research estimates, right, they need to actually raise treasury bills, short-term bills. That means they got to issue bills to fund this very low cash balance, to bring up the balance up so that they could actually resume their daily operations to pay their dues. So estimated amount is close to about 1.1 trillion that they will face it over the next half of this year. See. So now the big question over here is that, do not forget, the Fed is now doing QT, quantitative tightening. All right. So now, coming with this replenishing of this 1.1 trillion plus of T-bills that the Treasury got to issue is a must, because if they don't issue, that means technically they got
They run
no
out of
money.
cash, right? Like
no
you
money,
hit
right?
the debt ceiling, you don't get the cash. What's the point?
What's the point, right?
The question I have here, exactly, is the fact that with all of this going on, what does that mean to the USD? What does that mean to the index? What does that mean to the funds?
So now let's tackle on the liquidity style story first, the stocks first. So that now the most worst case. So this absorption, this 1.1 trillion absorption can be absorbed by two channels. I mean, not necessarily only on one. It can be a combination of both. Okay, one is through the traditional banks reserve. That means talking about banks deposits, and secondly is to money market mutual funds. So these guys will also buy up treasury bills to actually put it in their basket, and they will sell it off to investors as a short-term instrument. And now the big question is, if this absorption comes from the bank's reserve, so that could eventually cause a liquidity squeeze or drain in the market. That means we start to see potentially US Treasury yield spiking up because there's a drain. Okay, so that will actually increase cost of funding. And do not forget over here is that at this moment in time, right, the benchmark rate to price bond issuance, to price corporate loans, right, we talk about the 10-year. The 10-year now is trading close to 3.81%. So it actually went up a fair bit in the last 2 weeks. First, yesterday, US market closed. We got to see where is it trading later when the market start to open again, get a more clear picture. So the key thing over here is this US Treasury yield, right, as a benchmark rate, right, for funding, long-term funding, is now coming close to a level prior to that banking crisis in March. So if this absorption, right, is being taken up by banks reserve, more of it rather than money market mutual funds, there's a big risk that this treasury yield could spike further and causing a liquidity squeeze, which could create a negative feedback loop that we see earlier in March.
I think let's take a step back, right?
Yeah.
So and maybe hasten the pace a bit. So there's two things, right? There's two avenues by which the Fed kind of puts in or draws the debt or creates a debt essentially. One is they put it into the bank reserves, and that has the effect of tightening liquidity and maybe increasing bank losses. Then the other is money market mutual funds. Does the Fed have a choice?
Unfortunately, no. No, they got the
so
treasury.
Who decides?
Okay. So it's the market players.
Split
so right now, it all depends on where the absorption comes from. You see. So once I issue this treasury bills, it's all depending on the demand of this treasury bill. Who purchase it? So let's say if the money market mutual funds purchase more of it, then the liquidity drain will be less severe. But the next worst case, what if it comes from the bank's reserve? So at the end of the day,
banks
right?
purchase it.
the bank purchase, or the Fed were to actually purchase it via the bank's reserve indirectly. So that could actually cause the liquidity squeeze. So until at that point in time, right, we could have a clear picture, because right now there's this two avenues.
If
If
there is a liquidity squeeze, what does that mean? If there is a liquidity squeeze, liquidity squeeze.
So
What
if
does
there's
that
a
mean?
liquidity, there will be a situation where we may start to see a repeat of that regional bank crisis. Don't forget over here is that what happened to the regional bank crisis was their balance sheet issue problem. So this balance sheet problem is because they took on too much long-term treasury bonds that hit their balance sheet. So i.e. their balance sheet got hit, then there's rumors saying that, hey, these banks over here is that were your asset value now drop below your liability value. So that causes a bank run.
Okay, so one is, I think, as I said, it's a demand-driven process, right? So I
Correct.
guess query whether banks want to kind of increase their own reserves by taking up this parts of this new issuance, knowing that their own balance sheet is maybe a bit in trouble, and everybody is looking at their health to maturity ratios. Two is, I think, even if they do take it up, can't they just use this, whatever they, and if they do need liquidity because somehow it triggers another run, can't they just use this, as part of collateral for the new funding window that they have, right? And therefore be able to exchange whatever bills that they buy quite quickly for cash and be able to make depositors whole, right? So it's, I mean, less sure. It's maybe a bit of the same scenario as March, but we do have new mechanisms that have come up after that are meant to deal with this kind of like temporary liquidity crisis in specific banks.
Yeah, precisely. So now the problem is over here is that, will the market participants believe that? So that's a big question over here. Yes, we talk about the Federal Reserve, the U.S. Treasury. Yes, they do come up with this kind of mechanism to deal with that liquidity, potential liquidity squeeze. So right now the big question over here is that squeeze itself, were the secondary effects of it. That means, i.e., right, we're talking about speculators coming in further to push that treasury yield by talking about selling bonds. So eventually you sell bonds, futures, the treasury will go up. So eventually it creates this vicious cycle where the cost of funding eventually goes up much further. So now the key question over here is that, will these speculators believe that whatever measures that was introduced after that mini, what we call regional banking turmoil, solve the problem? Okay, so the problem with US, not the problem, I would say that
No, sorry, these are speculators on yields and bills, or speculators on regional bank stocks?
everything as a whole. So speculators on the futures, that means the futures market. So we're talking about the bills market, the bonds market, and as well as speculators on the banking stock itself. So it's a twofold thing, you see. So now
It's a cycle.
it's a cycle. So it's a
Right? Because
psychology.
if you are speculating on yields, so let's say you are selling bonds into this and squeezing yields up, right? Then you are
Correct.
kind of taking the loss there.
No. So now I'm shorting bonds. That means I'm shorting bonds. I'm squeezing the yield up. So if I'm squeezing the yield up, it will cause an feedback loop impact to the banking stocks. So right now over here is this, that,
And then you are saying that these same people will also short the banking stocks.
precisely, this is a double whammy effect. So now go back to the trigger. What causes the regional banking crisis to happen is yields, right? Yields keep going up, right? So their mark to market value, whatever bonds they hold, is in a loss, paper loss, correct? So despite it's still not a real loss, a paper loss, but people believe that because of this, it may lead to a bank run. So because of the speculators, they push it in a way it creates what I call a feedback loop impact, or they call it reflexibility in George Soros' theory. So this cycle, right? Yes, the Fed is at the point in time in early April, they do come up with some measures to put a stop to this reflexibility. Yeah, so it stopped for a while. Okay, so then you get cash-rich bank to come in and help.
So cutting this off at the source, right? Why would a bank, if you are managing a bank balance sheet, even take up any of this issuance? Because they have a choice, right?
Yeah, they have a choice. So they do have a choice. So now the question over here is, if the banks don't take up, somebody got to take up, right? Somebody got to take up.
Be the money market lah.
So it will be no. So
if the money market doesn't take up, yields go up, and then banks go, haha, at least I have a limited exposure. I haven't got increased exposure.
So now the big question is that, if the money markets take up, okay, let's say the markets don't take up so much, so somebody got to take up, right? So these are T-bills. So eventually, right, it will still take up by the Fed. So the Fed got to buy. The Fed coming to buy, right? So once the Fed coming to buy,
and then
right? Yes.
talk about the squeeze lah.
The banks are safe.
No, right?
No,
yeah,
the banks are
safe.
safe.
It's a bit
But
of
the squeeze,
left hand pass to right hand.
correct. But the squeeze will be there. That means, i.e., right, the yield will still go up.
No,
Because
okay. So, Calvin, I think
Yeah.
whatever the route is, whatever the mechanism is, I think the short answer is yields will go up. The question is, I mean, is there a route where the yields don't go up?
No, you can't. Now the big
Right.
question over here is which one will go up more? The impact of it. So definitely the first impact, right? If the banks were to absorb it, that one will go up much further because that will actually kind of induce speculators to come in much more to push up the yields, right? So there's a feedback loop effect. Okay, so if it's being picked up by money market mutual funds, the yields will go up, but to a lesser degree. That means that don't induce speculator. So now what I'm actually trying to say is the action of the speculator that causes this feedback loop cycle. So it's a bit different from fundamentals. Do not forget over here is that markets,
Okay, wait.
Yeah.
So
Yeah.
if money mutual funds pick it up, why wouldn't the same speculators try to push yields up?
Okay, because market mutual funds, right, at the end of the day, right, they are not banks.
No,
They
but
are
at
not
the end of
banks.
the day, your action to induce yields going up is selling short bills. It's not, and then whether you short banks, it's a separate part of the story, right? It's the second
Yes,
limb of the trade.
I agree. So now the thing about this is that because market mutual funds, right, at this point in time, right, what they do over here is that they sell. Okay, don't forget they are the business of selling these T-bills back to the market.
Yeah.
So you see how they absorb, right? Once they absorb this T-bill, they can sell it out, right? So once they sell it out the market, right, at the end of the day, right, do you realize that the money supply gets go back to the market again because investors got to buy these market mutual funds, well?
Yes.
So now,
No,
correct.
correct. No, look.
Yeah.
So I agree with you. Money
Yeah.
market mutual funds, that mechanism maybe has less of a liquidity impact, right? What I'm not so
Yes.
sure about is when you talk about the banks, you talk about there being some group of speculators that will try to push yields up. Why can't that same group of speculators, even if the issuance is being taken up by money mutual funds, also try to push yields up?
Because of the way the narrative works. So it's a psychological thing, you see. So you see
Okay.
this kind of speculator, right, they tend to look back in the past what happened. So they
Okay.
realize that, hey, in the past, right, this narrative, right, causes the yields to spike up further, which is, what happened
Okay.
in the regional banking crisis.
So essentially they're trying to find an analogy to a previous event and then say, okay, fine, this happened last time. Let's try to do the same attack this time, and maybe it works this time as well.
Or benefit from it this time.
Yeah, so
Yeah.
the thing about this funny thing is the recency bias, because in psychology, so these speculators, right, they tend to have this recency bias that they are very successful in their previous strategy, and they look at this same analogy to apply it right now. So I think that's explained a very clear picture. See?
If I can bring this back, right? So,
Yeah.
okay, say the debt ceiling increases. This is upon the fact that it's agreed that debt ceiling is going to be increased, right? And hopefully
Yes.
it will. At that point in time, money market mutual funds will absorb some of it, but the rest might be absorbed by the Fed or by the Reserve Bank. This will then increase yield, either by
Exactly.
speculation or whatever. That for me is how, to what degree, as us investors, if this is going to happen, what do you recommend we should do?
For now, right, if you are talking about the
It's
situation,
coming, it's inevitable. There's nothing you can do.
No, so you're talking about investors right now, right? So number one, you
Yes.
got to look at this situation now is if you go back to the picture of 2011, yeah, the market did don't think here, the market did fall by 20% or so, but eventually the market rebound, right? But that also depends on number one, we got to be very nimble in the way of how we tackle this situation. So we could potentially be say, hey, don't immediately fire your shots, you see. So you got to keep some ammo towards the end of the day. And now because the question is what will the Fed do? So do not forget that the Fed now is doing QT, right? So eventually yields will go up. Okay, whether it goes up on a drastic way where speculators push up further or the normal gentle way. But with QT in mind, right, that means this yield itself, right, coming back down again to, let's say, we're talking about 1%, or because the 10-year yield now is about 3.8%. So going back down to 2% or even below this year's low, which seems to be very remote right now in this case. Because the Fed already said, I do not want to pause. Even if you look at the current situation, right, the Fed funds futures, right, 4 weeks ago, we are talking for a pause, close to about 60+%. 4 weeks ago, that's 4 weeks ago. But right now, despite the US debt ceiling thing going on, right, the market expectation now after the latest round of Fed speak start to price it at least 60% chance of a hike in June. So there's a 180-degree turn. So the big question over here is the Fed seems to be doesn't look at the short-term picture. That means, hey, never mind. Even though there's a liquidity squeeze in the system right now, right? My clear thing is right now I'm still looking at inflation rather than
Okay.
the adverse effect of the liquidity squeeze.
Yeah, so I think a few bits that I want to pick up, right? One is,
Yeah.
I completely understand kind of reasoning back to the 2011 debt ceiling debates and what happened there. I think the main difference here is that, hey, this time round, markets did not fall 20%. There was no, kind of temporary cheap bargain to pick up as the uncertainty picked up,
Yes.
right? There was
There's
a bit of
nothing.
uncertainty here and there, quite a lot of uncertainty here and there, but then market just boom, I just go up. I do not care what people say, I just go up, right? But
Okay.
other than that, going back to more important point, I think about the Fed and all that, and I thought it was kind of surprising that okay, we are now kind of pricing in another hike in June. I think, even though last time round they were sort of hinting at a pause, and as it relates to the banking crisis, I think actually over the last few months, maybe the Fed has got a bit more confidence in the sense that if there is any liquidity squeeze on a particular bank, it is something they can control, right? It's something that they can kind of like, oh, it's a small tumor, I excise it, I move on with life. It's not going to be a stage 4 cancer that's spread across the entire system. Unlike full-blown banking crisis in 2008, right? This is liquidity, I control liquidity as a Fed, I can kind of deal with it. I think what's maybe a bit more concerning to me is that, well, they're going to hike rates. Great, I think that's fine. We seem to be approaching the point in the cycle where things start breaking down, right? And all these liquidity squeezes and all that are kind of symptoms of that breakdown. So if we are going to keep hiking and if we are going to continue doing QT and quasi QT by this large issuance of bills, then in a sense, are we increasing the risk of over tightening?
Yeah. So this question over here is a lot of people looking about the Fed put, right? So the Fed will come in and rescue the market, all this,
It's gone.
Usually, yeah. So that this Fed put doesn't seem to be working right now at this point in time.
I mean, the market keep going up, the Fed want to put also cannot.
Yeah. So now
Nothing for the Fed to save.
yeah, so now the big problem is this market, your market is going up, but it's only one area of the market is going up, which is you talk about the AI stocks, right? And the tech stocks is going up. So you look at the Dow Jones and the Russell 2000, they are not going up,
This would be a shitty bull market if you know the bull market,
So it comes to the point that then those value investors, you look at, hey, are you going to take a look at Nvidia, which is trading at what 48, 50 times right now? So the big question over here is that for even though if you are a long-term value investors, they're saying that yeah, I know that there's this so-called tech stock that are quality stock is going up, but is it worth the money buying at this PE ratio, be it forward PE ratio or whatever metrics? Then the next question is, hey, I hunt for bargain stocks in the Russell 2000, like we're talking about some of the smaller cap stocks, or we're talking about defensive stocks like healthcare, which have a relatively lower PE compared to the S&P, which is like 18 times right now. Then the next thing I'll ask ourselves is, hey, yes, I can look into that, but what if I underperform the market? Because at the end of the day, my bonus still depends on whether I can beat the market or not, right? So there's some fund manager, they have this stupid mandate inside their team, right? I cannot buy stock at a premium of XYZ against the benchmark index, you see. So the thing about all here is that they are stuck. A lot of people are stuck at this moment in time. So the big question over here is it's going to be very challenging, especially if you are looking at the US market to actually as one of the asset class. So if you go to Asia, it will be much more easier because valuation are cheaper, and that's why Japan now is booming at this point in time.
So what you're saying is there is all likelihood that it's going to be approved. I mean, I assume it's going to be approved, but we'll know soon enough, right?
Yeah.
At that point in time, there will be a squeeze no matter what happens. At that point in time, the yield will go up, which could mean that, the market in the US is not a great value for investors to do so. You expect maybe perhaps a bit of a decline in the market. Am I right to say so?
Yep. Yes. So there's a bit of...
You go up, stock go down. I think that's been a lesson over the past 18 months.
Yeah. Then, of course, the other question, I mean, which we didn't touch on was the FX, but we don't need to touch on it today, right? What does that mean for the USD? But so if that happens, where else can our coconuts put their money into?
Right? Because and we move on to the next story.
If US is becoming tight and, a lot of people are investing to the US, let's show them something else that they can invest into. Maybe, Calvin, take us through what's happening with the Nikkei from all of this US debt ceiling talk.
Okay, so Nikkei has been underperforming against the rest of the world for about 3-4 years. So the
20.
Oh, okay, so yes.
It's
So
not
there
lost
are,
decade anymore. It's like lost decades.
Was it
Yes,
1990s was the
so
last good one, right?
okay, in terms of don't talk about the China, don't talk about the Singapore, we talk about like Europe and US. Even Europe itself, you look at some of the benchmark like DAX, right, or the CAC 40, they are already surpassed their previous all-time high. Then US is keep making new highs, you see, in the last decade or so. But Nikkei still below it 1990 high. That was the
Okay.
property bubble burst. So since then, right, there's this thing about deflation spiral. Okay, that means, i.e., we're talking about big growth and low prices. So with that, right, we start to see export of a fleet of capital. That means Japan itself, there are Japanese corporation and their institution whatsoever. They are the biggest exporters of capital
Yep.
to the rest of the world because no point investing in my own country, right? We're talking about deflation, right? So all the MNCs start to invest overseas. So that actually kind of lead to what I call the lost decade in Nikkei. And also do not forget over here is that in the early 2000, starting from 2000, 2003, we start to see the birth of BRICS, BRICS, which is emerging markets. So everybody talking about, hey, emerging market is the new sexy thing. Why? Because we're talking about demographics are good. It's a very young population. So we're talking about young population. There is chance of high productivity lead to high growth. So a lot of us say that, hey, BRICS itself is one of the asset class or a geographical class to look at. So that actually causes a double whammy for Japan. Old aging population, low productivity, forget about it. All right. So now the question over here is start of late last year, China has now facing a kind of a China is one of the champion, one of the star of BRICS, together with India, definitely.
I think the whole BRICS except India is gone, and even India has like some problems, right? I mean, Brazil has corporate governance issues. Russia is dead. Even if you got money there, you can't take it out. India,
correct.
South Africa, no, don't bother. So yeah. So maybe to shortcut this a bit, part of the attraction of Japan now are really two things, right? One is, they have really been trying to stimulate inflation for the past 20 years, have failed miserably until global inflation, took root, and then, hey, Japan got affected. So they got some inflation there now. Finally monetary policy did some
It's working.
thing. I mean, don't know whether it's monetary policy or something like that. Finally, the effect they wanted happened,
something
right? And then now they are going, oh, okay, fine. I might need to change my monetary policy a bit because I don't need to keep stimulating inflation, right? I think that's one, and I think that's maybe the big one. Two is, I think that there's been, Japan has always been seen a bit as undervalued, same as the DAX, same as the London Stock Exchange. Everybody for the past decade has just looked at tech, right? Because if you're not in tech, you were kind of, you confirm lose to your competitors. So now that tech is maybe losing a bit of its shine, then there is a bit of a flight towards other markets, right? And pushing of liquidity into those other markets to get the gains to get the returns that they need to get. And I think partially, Warren Buffett lent a lot of his aura to this by saying, oh, I've gone to buy all five of the big Japanese trading houses. And that is where I think my growth is, that is value to me.
I think that is a very significant marketing push, you see, to make Japan great again. because don't forget, the thing about Warren Buffett, right? The philosophy of Warren Buffett is he always invests majority of his portfolio in US. That is philosophy, because he
like
then
don't
right
bet
now
against America, right?
yeah. So now he's suddenly saying that, hey, after he make a trip to meet the key policymakers in Japan, and now he publicly said that, hey, Japan is my kind of second largest portfolio right now, in a way. So that actually lent a bit of credibility about this Japan resurgence story, at least in the medium term. All right. Because we're talking about long term, right? We still look at productivity, you see. So the thing about Japan over here is that due to the culture philosophies that they don't really look at ways to replenish their workforce through foreign talent in a way. So everything they tend to be more localized, and definitely you look at the birth rate of Japan is you won't see it changing this year or the next 5 years, you see. So in the long term, it could still be a drag, you see. So, but in the medium term, Vietnam is the thing about investors right now, even tactical investors, is because of Tina. There's no other alternative to look at.
No, I mean, I get your point. I think Japan is an attractive Asian story, especially if you can't do China, right? To me, the alternative is China, right? You want exposure to emerging markets, to Asia, to big Asian markets. Well, China, some people consider uninvestable, right? Whether it's political risk or I just don't like it. So who's closest to it? Well, there's Japan, lah, and
Yes.
to the extent that we start de-risking into different
Okay.
supply chains, then
Yes.
whatever is that's being done by China now really gets onshore or nearshore, into the closest allies, and in which case that'll be Japan and South Korea, and that really
Yes.
pushes the domestic economy, or at least the Japanese companies, up a bit.
Yes, precisely. So that is one area where the geopolitical situation right now is actually supporting this, we call it de-risking, where we start to see supply chain being flown back to much more, we call it friendly countries. So Japan will tend to benefit from this, you see, in one area.
Yeah, and I have a question here, right? These seem
Yeah.
to be external factors affecting the Nikkei, right, or Japan.
Yes.
Right. These aren't actually internal factors, with the companies, et cetera, like what you've just said, right? Because companies are investing elsewhere. What happens when these external factors change, for example?
So there's actually two push. The biggest push of the internal factor will be flow of funds back into Japan. So don't forget that Japanese, you have this very big insurer, the Japan's insurer. There's a name for that in Japanese. I think recently most of their holdings are in international stocks. Yeah. So right now, right, based on the latest report put out by them, they are now slightly more in favor of investing in their local Japanese market. So that is really
So
trillions
we're
worth
starting
of
to see investment inside.
trillion worth of ammo that could be actually flow back into Japan. So we're talking about potential flight to capital back to Japan. So that's an internal factor. And I believe that the biggest pusher of this internal flight to factor got to come from BOJ itself, the Bank of Japan. Okay, so the funny thing about Japan for our listeners, right? Core inflation, right? Core inflation is excluding energy and food. In Japan, right, they have this one called core inflation and core inflation, core square inflation. Core inflation in Japan, right, is excluding food. Then core inflation is excluding food and energy. Okay, so you look at the core inflation, we call it sticky inflation, has been accelerating at a very fast pace. So especially the most recent one on last Friday, they call it the Tokyo CPI core inflation actually went up to close to about a 30-year plus year high at 2.4% year on year. So if you look at the speed of acceleration of inflation, right, be it core or core inflation, right, it's been close to about 7 or 8 consecutive months in a row so far. It's the longest so far. There's been above BOJ target of 2%. So now the problem over here is this. BOJ itself has been rather hesitant to normalize their ultra easing policy. That actually causes, hey, since you don't normalize, right, my flow of funds will still be in Japan looking for better yields, outside Japan looking for better yields. So now the BOJ, right, a lot of speculators, a lot of research houses saying that Japan is still dependent on the global economy. So right now, global economy is still doing fine. I mean, we're talking about US itself. Worst case scenario, we're talking about a soft landing so far. We don't call it a very hard landing. So the window of opportunity right now for BOJ to normalize its policy, but at least giving a bit of guidance by not say from negative interest rate immediately to positive. The first plan they could do is to extend their yield curve control policy. Because right now they're still allowing the yield to be at 0%, the 10-year Japanese JGB yield, but fluctuate by 0.5 and negative 0.5 between the rates. So now they already extended in somewhere around in November before the ex-governor left. So right now, the opportunity for this new governor, perhaps somewhere around the second half of this year, this is the best chance for him to actually do it. Rather, if you delay for another year, what if US goes into a hard landing? There'll be a big problem, right? For you to normalize your ultra
So
dovish policy.
in your case is to say these are external factors. These are the things that are happening. Yes, there are some internal factors with your company, but now it is a brilliant time for Japanese policymakers to be making these moves because there is traction.
Yep, precisely. There's traction right now. So the key thing is that if they start to make this move, right, if everything goes well, especially the JGB yields don't spike up, because what they are afraid, right, is because, let's say speculators again, because of this Japanese inflation keep picking up and speculators start shorting the JGB by the futures market. So the more they short, right, there's a big risk that if suddenly BOJ say, hey, I just removed the YCC, can you mention the 10-year yield, right, from what 0.5% could just spike up to 2% overnight. So that will be a big problem for Japan.
Exactly.
It's a big risk. So BOJ do not want that to happen. So you look at right now, right, the way Japanese policymakers are. So I believe that couple of months down, there will be some guys who are being what I call this Yuda expert of speaking, his way of speaking, or try to decipher what he's saying. So right now, he's bringing a big message. He said, hey, Japan's economy are good. we are looking to normalize. Then after today, he's saying that, hey, we are still a bit concerned about inflation. It may not be as optimistic as it could be. It could fall back slightly in the second half of this year. So we're going to keep our policy as status quo. So he's throwing a lot of mixed messages. So I believe that his tactic, right, is to prevent speculation in the JGB futures market.
To avoid that jump.
He wants to make it. I also believe that he's not a bureaucrat. He's an economist. He do understand the window of opportunity present to him right now. So what his concern is that he do not want, hey, after I normalize, overnight the JGB yield, the 10-year JGB yield spike up to 2%. So I think he does not want that to happen. Yeah. So he's now trading a bit of water over here, is it?
Got it. So I guess the question here is, let's see what's happening with the US debt ceiling. But the other opportunity here is a flight to capital into the Nikkei, right? And you can buy the index, for example, an index fund or whatever that you'd like. But there is an opportunity in Japan that we should be looking out for. In other words, coconuts, that's what you're trying to say, right? Coconuts, look at Japan. That could be an opportunity. Do your own research as usual. Wait, this is not financial advice.
I'm going to come with counterpoints to this, right? So one is, definitely liquidity is flowing. That's great. But I think we are not Warren Buffett, right? So what Warren Buffett kind of did very interestingly was, instead of getting his USD to convert into JPY and buy, he took out JPY loans to buy whatever shares he needed to buy, off the face of his balance sheet.
Yes.
So from there, he didn't have FX risk in that sense, or he could hedge his FX risk, right? Because
Precisely,
because of that, he took a bit of an interest rate arbitrage because JGB yields are low, so his JPY loans are cheap, right? So he could structure all that to kind of get a bit more leverage and a bit more and boost his returns a bit. As retail, you don't necessarily have the same. You definitely don't have the same.
We don't.
Right?
We don't.
I go to DB, I go to SMBC and ask them for a JPY loan. They'll laugh at me, right?
Yes.
I want JPY loan to buy stocks. JPY loan to buy SMBC stocks. They'll laugh at me, right? So one, that's not going to happen. You are not Warren Buffett in terms of whatever structuring and resources you can do, right? And two is, I think, Japan, and part of the reason why Japan has always been a bit of a value trap is there is a lot of complexity. There is a lot of lack of transparency in the market, whether it's because the companies themselves are very tightly held. There's a lot of cross holdings even within conglomerate groups. So you don't actually know, you can't untangle that much who owns what, right? And you can't really access enterprise value in the same way that you would, because your web of holdings is just too tangled. So there were real reasons besides just liquidity that led to Japan being a bit of a value trap. There is a bit of a shift in terms of like corporate governance attitudes and people wanting to do better for shareholders and all that, which maybe closes that gap, right? But that's a work in progress, and asset management, all that, trying to get the essentially Japanese public equities to not be so stick in the mud, right? But that is taking a while. And that's also why Warren Buffett doesn't buy one company, right? He buys the 5 big trading houses. He essentially goes, I don't need to analyze all of you. I just try to buy the 5 biggest ones, right? Because y'all will do well in the industrial age, and Japan will do well, and I have loans, and that's that. So he hasn't gone, this one is value, the other one. Or he just goes, I buy all 5. I don't care, right? It's like buying Samsung and SK Hynix and the SK Group and all of that. I just buy all the conglomerates. So I think there are real risks. Like Japan has always been risky for various reasons, like FX and all that. There are still real risks to that, right?
Yes.
Liquidity flows might push the markets up a bit and maybe close the valuation gap a bit. But given that it has pushed it up quite a bit already, are you kind of squeezing the last few drops of juice from it if you're entering now? I think that is the question, or is the expectation that a lot more liquidity will start flowing in over the next year or two, and therefore it is a continued rise. And you couple that with like changes in the actual market structure itself, then that will lead to good times for Japanese stocks.
Yeah, precisely. So I think, Anthony, what you made is very good valid points on, especially on the corporate governance side of the story. So that was one of the negative aspect where actually causes Japan to underperform against the rest of the world in the last 10 or 15 years or so. Like I say again, as retail investors, right? I mean, we don't have the financial resources and muscles like Warren Buffett, where he's able to structure a hedge trade on the Japanese stock. So I think one way over here is, so before I put a disclaimer, I'm not trying to promote any company. There's actually out there right now, we call it FXH ETFs, exchange traded fund for investors. Investors could actually Google this ETF manager called Wisdom Tree. They have a H ETF on Japan. Yeah. So I think that's the best I can go. Not promoting them, but it's a knowledge that
USDH or SGD?
It's actually USD. So they take off the FX risk. So what you're seeing now is actually the pure return in terms of dollar. Yeah. But
less hedging costs, but yes.
USD.
On the draw side, there will be some. So it's become active management, you see, a bit of active management. So the cost will be slightly higher.
Yeah.
Yeah. So it's a bit of research. So I believe that this is the current ETF at this point in time that offer H ETF.
Yeah.
It's a good knowledge to actually take a look at it. Yeah.
Cool.
Okay, cool.
Fair enough. Thanks so much. I think this was informative. We did go back and forth. It's also taken us quite a while.
Interesting.
But I think this was quite informative, right? Because of just one thing that we're talking about and all its cascading effects.
Yeah,
It's
and we
a
haven't
simple
covered
example.
I don't think we've even covered half of it, right?
No, we haven't. We haven't even considered all the variables yet, right?
So I think the smartest way is what we said. I think in Market Update. Oh, sorry, none of you were there, right? Rakesh, you were on holiday. So you said on Market Update 3 weeks ago. At the end of the day, they'll pass it. There will be temporary effects. They'll all go back to normal. Stocks will go up and to the right. Just buy. Don't care. Just buy.
Please, I wish. He's saying that because he's the Warren Buffett.
No, I mean, we have been like kind of banging the table on Nvidia last year or so.
We have.
So yes.
Yeah.
Anyways, thank you guys so much for coming through. Kelvin, thanks again for coming back. This was once again informative. And Coconuts, hopefully you learned a thing or two. Not too confusing out there, but we tried to bring as much structure as we could. And we'll see you again next week.
All right.
Thank you, guys. Thank you.
Thanks for tuning in to this week's episode with me, Rakesh, and trust that you learned something today. If you enjoyed the session and want to be part of the banter, join our community Telegram group or follow us on social media. We also have a weekly newsletter to get a digest of the news we covered. To sign up, please click the description below. As always, we love your feedback, so share that with us at hello@thefinancialcoconut.com. Thanks, and stay safe.